light on precious metals and the kind of performance that we have seen this year so far, since it is the last day of this calendar year. Gold now is trading near that $4,285 per ounce mark in the global market. Remember, on a year-to-date basis, gold is up a solid 64%. This following solid returns that we have seen over the last 2 calendar years as well. Remember, in calendar year 2024, gold gave an average return of about 27%, and in 23, gold gave returns of about 13%. But this year, it has clearly bucked the trend. In fact, as compared to all other asset classes, precious metals has been the best performing asset class this year, with gold giving returns of nearly 64%. But remember, silver clearly has outperformed gold, and the white metal is now trading near that $71 per ounce mark. It is up a solid 145% this year. This is after a rally of about 22% that we saw in calendar year 2024, although silver did not give any returns in calendar year 2023. But remember, several factors continue to remain at play for the precious metals market. One, of course, was geopolitical tensions, which failed to ease despite expectations of easing geopolitical tensions. So that was one factor which aided safe haven demand in the global market. Remember, central banks continued to buy precious metals and dollar index was falling. And remember, there is inverse relation between dollar index and precious metals. So whenever dollar index falls, we see an uptick in precious metals, and dollar index has depreciated nearly 10% in calendar year 2025. So that was another factor which led to the up move in the precious metals market. But on the flip side, we had oil, which has declined. In fact, now it is trading near that $61 per barrel mark. It has recovered a tad bit from $58-60 that we saw a few days back. But despite that, on a year-to-date basis, Brent crude, remember, has declined nearly 18%. So 2025 clearly was the year of precious metals, but oil has seen a decline. But shifting focus to the biggest news story of the day from the commodity market, and that is for the steel sector, where the government has gone ahead and imposed safeguard duty on import of certain steel products. This, remember, will be for a period of 3 years. It will be levied in a staggered manner. 12% for first year, it will be lowered to 11.5% in the second year, and about 11% in the third year. Remember, this will be levied on import of steel from 3 countries: China, Vietnam and Nepal. Remember, import of steel from these countries into India has been a big problem for India's domestic steel manufacturers, because of which the industry had appealed to the government to impose safeguard duty. It was levied for a period of 200 days in April, which lapsed in November. And now the government has said that this will be applicable for 3 years. This is with effect from April 2025, 12% this year, followed by 11.5% and 11% in the consequent 2 years. But what does this mean for India's steel manufacturers? To understand that, we are now joined by Mr. Dhruv Goel, CEO at BigMint. Mr. Goel, afternoon, and thank you so much for taking your time out and joining us here on ET Now. And let's start with the most important and the most relevant question in the context of safeguard duty being levied by the government. Where do domestic steel prices stand currently versus import parity? And basis the difference, is it really beneficial for domestic steel manufacturers at this point in time?
The current prices are still at a discount after safeguard duty, if we factor the safeguard duty. So if I have to give you in the numbers, the import prices from any country would be anywhere between, $520 to $530 on CFR basis. And if we, add 12% of safeguard duty, it will be the imported landed cost of imports would be expensive by approximately 4,000 rupees against the domestic prices which are prevailing in Indian market.
Okay, and so if domestic steel prices are anyway below import parity, the big question now is, will the safeguard duty provide relief to domestic steel manufacturers in the short term?
Yes, it will. It will, because it means that no, but before, in case if safeguard duty would not have been imposed, so it would have been at par. It means that somebody importing HRC or any other flat steel product from countries like Japan, China, then they would have been at par with the domestic prices. Now, after safeguard duty, they are expensive by 4,000 rupees. So it means that people have to be dependent on the domestic supplies.
Okay, so people will have to rely on domestic steel manufacturers. That's the word coming in. And Mr. Goel, what about the benefits to the industry in the medium term? Since the duty has been levied for a total period of 3 years, what kind of benefit will domestic steel manufacturers enjoy on account of this duty?
So definitely it will benefit because this notification covers approximately 60 to 70% of the products that gets imported to India in the steel context. So that will give a relief to the steel manufacturers in the medium term. It means that imports will always be expensive compared to domestic prices. So people have to look for domestic supplies. So yeah, it will give relief to the domestic steel manufacturers. But at the same time, there's a threshold limit. It means that the HRC, for example, has to be at 675 because this duty is only applicable when imports are below $675 or for HRC. Similarly, they have set threshold limits for other commodities as well.
Okay, and Mr. Goel, according to you, what does this move indicate as far as margins are concerned for both long and flat products? Now that the safeguard duty has been levied, do you think steel manufacturers will ultimately increase steel prices, which will benefit their spreads?
So, as you know, because with this duty, imports will be expensive, and as I mentioned, that the mills will have some scope to improve or increase the prices, so that will have direct impact on their margins, and it will benefit all the steel makers. But this duty is specifically on the flat steel products, which cover, HR coil, cold roll, coated, and plates. It does not cover the long products. So, companies which make flat steel will benefit from this move.
Understood. So the companies which make and manufacture flat steel will benefit more as compared to others in the industry. Mr. Goel, since we are talking about exports, how have we were talking about imports, but let's also talk about exports. How have exports from India shaped over the last few months? Is dumping of Chinese goods into other global markets other than India hurting exports from India as well?
To a certain extent, yes. If you see Chinese steel exports, China exported approximately 110 or 115 million ton. They will be exporting these numbers in 2025, which will be higher by 6% from the last year. And these numbers would also be 7 years high. It will certainly has impacted Indian steel exports because there are several markets which India used to cater, like Southeast Asian countries like Vietnam, Indonesia, Thailand, or some parts of Middle East or Africa, which wherein India was active. Now those markets have been captured or have been supplied by China. But in last few months, we have seen some activity or some exports activity picking up from Indian market for a couple of reasons. One, since the rupee has depreciated, so that has given a better realization for the Indian mills. And second, because in Europe, which is a major trading or export destination for Indian mills, therein the CBAM will be starting from 1st of January 2026. So that has seen some kind of restocking. That market has seen some kind of restocking. So exports have picked up in last 1 month or say 1 month or so.
Okay, so exports have also been impacted on account of higher dumping of steel by China into the global market. That's the word coming in. Mr. Goel, thank you so much for taking your time out and joining us here on ET Now and helping us understand what kind of impact will the move by the government have on India's domestic steel manufacturers. Thanks so much for joining us today. But shifting focus to our next segment, did you know? And we will tell you some interesting facts and figures today. Almost a decade ago, in 2016, Bajaj Auto had unveiled a new motorcycle V. What's special, you'll ask? It was made using the metal of India's first aircraft carrier, INS Vikrant. INS Vikrant was commissioned as the first aircraft carrier of the Indian Navy in 1961. And after years of distinguished service, it was decommissioned in January 1997 and was placed in a museum till 2012. In November 2014, the aircraft carrier was dismantled and sold as scrap metal. Bajaj Auto purchased the scrap and processed it to be a part of the brand new V that was then sold in the Indian market. That's all the time we have on this edition of Commodity Central, but don't go anywhere. More news and updates will continue on the other side.